Hey everybody, it's time for another Personal Finance Friday, and today we're having a quick discussion on target date funds. We'll be right back after this. And we're back. Again, it's Personal Finance Friday, and today we're talking about target date funds. Now, we've already covered in a previous episode mutual funds in general, and in that episode we mentioned target date funds. Target date funds are a mutual fund comprised of other mutual funds, sometimes referred to as a fund of funds, but they're always from the same company. So a Fidelity target date fund will be comprised of other Fidelity mutual funds that make up the asset allocation. The target date chosen in the name varies in 5-year increments, so you'll see them as 2040, 2045, 2050, 2055. And these dates are geared to be used for someone who will turn 65 on or near that date. These funds are often used as the default mutual fund selection in a company 401k plan when the employee doesn't choose anything else. So when you sign up for it, and if you don't choose anything particularly on your own, the company will automatically put you in one of these funds that the target date is around the time you turn 65. Now, that's not necessarily a bad thing. For a young worker who's just signing up, say you're 25 years old and just joined the company and signing up for the 401k, you're looking at a time horizon of roughly 40 years to the time you turn 65. So you might be placed in one of these 2055 or 2060 target date funds. And let's take a look at one of those. This will be the Vanguard Total Retirement 2055. Now, what you see here is an asset allocation breakdown by the funds that it's composed of. As you can see, these are other Vanguard funds. The majority holding is a total U.S. stock market. The next is an international total stock market minus the U.S. market, or ex-U.S. it's sometimes referred to. And then there is a U.S. bond market and an international bond market. These 4 funds pretty much cover the entire stock market and the entire bond market for the world, which is not a bad idea. It's a fairly simple approach, and that's great. It's an easy to understand, easy to implement, and it's a great starting out option. If the employee does absolutely nothing else, they could invest in this fund their entire working career with that company and come out not too badly. Now, what's going on that you see here in the asset allocation, we can make it look a little more simplistic by looking at a pie chart of that breakdown. Now, the total allocation for somebody just coming into this fund today is roughly 90% stock, 10% bonds. There's a little fraction there off there. Now, as we move through time, as your working career moves forward, this allocation will change in something called a glide path. Now, the glide path for every target date fund is different. Each mutual fund company does it slightly differently. But what happens is the allocation towards stocks and the allocation towards bonds shifts over time. So 2 years from now, instead of being 90% stock, 10% bonds, it might be 88 and 12. 2 years later, it might be 85 and 15. That will vary by mutual fund company. But the goal is to shift towards bonds as you get closer to retirement. That's pretty much the discussion. We'll have a more detailed explanation of the glide path, so an illustration of what that looks like in a different episode. But that's pretty much the gist of a target date fund. It's a perfectly viable option. It's a simplistic investment approach, but it works. It's the default for many 401k plans for your company to pick it for you. So all in all, not a bad option. That's it for today on Target Date Funds. Thanks for joining us, and see you next time.